Welcome back. You're still tuned into Trading Hour. It is still looking extremely weak for the market right now. All sectoral indices in the red. We're seeing a near 200-point cut on the Nifty right now. So just slightly off the day's low. And it is the mid-cap index and the banks which are actually seeing a bunch of the pain. So the banking index, the Nifty Bank is down over 2%. You have the mid-caps also which are looking at an almost 400-point cut. But let's talk about some individual companies now because they're in focus after their earnings. Chalet Hotels is on our radar. The company posted a strong performance with revenue up 17% sequentially. I don't want to compare it, versus last year because we still did have a little bit of the COVID impact at that time. Occupancy for the quarter came in at around 75%. So we have Sanjay Sethi, Managing Director and CEO at Chalet Hotels, joining us now to take some questions on the earnings. Mr. Sethi, good morning. Thank you very much for joining us. This is Pavitra. We were just talking about the numbers, but can you tell us how occupancy is looking now in the past couple of months? I know for Q3 it was 75%, but that's also a seasonally strong quarter for the company. So can you tell us how occupancy levels are looking in the past couple of months? Mr. Sethi, I think you're on mute, so if you could just take that off.
Apologies for that. I said good morning, Pavitra, and the ladies in the panel. We're very happy with the best ever quarter that Chalet Hotels have had in the history of the company. So we're excited about that to begin with. In terms of the key numbers, I think occupancies were at 65%, not 75% for the quarter, but that was driven by the fact that October is typically a weak quarter for us when the holiday seasons happen. In October, we lost 18 days, and then December, we lost 14 days. But overall, extremely gratifying quarter where sequentially, our revenue was up 18% without the one-off entries, and EBITDA was up 35%. We've been able to actually clock that at 5.5x sequentially, which is, again, extremely gratifying, as I said. The strong part of the story is the rates are finally up, and they've been going up 3 consecutive quarters now. In fact, the growth over the previous quarter on the average room rate was 28%, which is really heartening for the industry. It seems to be holding there. We've seen that happen for 3 consecutive months now. F&B revenue is up 20%. And overall, a very positive story. And, because now this has happened for 3 consecutive quarters and we see this quarter panning out well too, I think we are on a roll over here.
So what is the kind of occupancy that you're seeing right now?
So this month is going to probably close in the 70s. But the rates continue to be northwards of 10,000 rupees, which is the highest that we've had since the global financial crisis now.
And the advance bookings that you have for February and March, should we expect occupancies to stay above 70%? And you're a little bit more about the pricing. It was at 10,168 in Q3. Does it stay at the same levels, or do you think you can push it up for the 4th consecutive quarter now?
So, Reba, you've seen the rates holding. We are at 10,000 plus this month also. February will probably be stronger than January, so we see occupancies being in the high 70s there, and the rates should continue at a 10,000 plus point. March will stay again very strong, so February and March look very, very healthy and strong. I think we are now reaching a point where this is now the new normal for us, where the rates are going to be in the 5 digits.
Okay, got that. Mr. Sethi, hi, good morning. Surabhi here. Yeah, ask some of your customers about that price increase, right? ARR 28%. We know, even before you tell us. But okay, that's on the lighter note. Give us some sense on the corporate side as well. For the longest time, we would always talk about how the events are not happening. Corporate side is absolutely quiet. How has that picked up? Are you expecting a lot more traction? And what's the corporate contribution now to the revenue? And just a quick word on margins. They're looking very, very robust at 39%, but are they sustainable?
So, I think it's been over a year that I've been saying that corporate travel will come back. And we've actually seen that come back over the last 2 or 3 quarters now. We are actually above normal on the corporate travel segment. So clearly that's back and it's here to stay. Similarly, with the MICE business that comes from corporates, whether they're meetings, incentives, and conferences, they're back with the bank too. The social segment with the weddings, etc., is back very strong too. In terms of margins, yes, we actually had a margin of 41% last quarter. We expect that to be sustained. We expect basically Chalet to perform at 40 and above on an annual basis going forward.
Okay, Mr. Sethi, you also had a lot of rooms which you're adding. So I think 90 rooms at Novotel. You have around 170 at the Westin as well. Can you tell us what is the additional revenue that you would expect from all of these rooms which, which are being added, and what is the timeline on this?
So we expect to operate the additional 88 rooms at Novotel at Pune perhaps by end of February. So we'll get some of it in this quarter. The rooms at Hyderabad, which are 168, it's the new hotel actually, will get operational by early April. And we had 121 rooms under renovation at Hawaii, which have now been handed over in the next couple of weeks. We'll see them come back into operations. So we are seeing roughly around 300, almost close to 400 rooms that come into play starting April onwards, which will basically increase our inventory by about 18%. We see that having a very positive effect. And on a RevPAR basis, there's no reason that we will not achieve the same RevPARs that we achieve from the rest of the rooms. And the RevPAR in Q3 was 6,640, with a very high contribution.
You also have some office spaces which will come on board, right? In Powai as well as in Bengaluru. And that typically has higher margins. Could you give us an indication of what the consolidated EBITDA margins could be now that occupancy is picking up, your commercial spaces are giving you higher margins? What could we expect on the EBITDA front?
So Rima, we don't want to give forward-looking numbers, but we'll have at the end of this play around 2 million square foot of office space in operation in the next couple of quarters. The 2 million, out in that 2 million, about 1.25 million is in Mumbai. The balance, 1.5 million is in Mumbai and 1 million in Bangalore. Mumbai rates are going to be in the range of 120, 130. Bangalore's clocking around 60 odd rupees. And we typically have an 88 to 92% flow through on EBITDA margins from that. So there's a math to it. So the 2 million square foot of office space, 400 rooms almost coming into play almost immediately. This is going to grow the portfolio fairly aggressively. And we expect that not only to add to revenue, but also improve margins for us, both on account of the office space and the fact that the additional rooms will have lower fixed costs.
Okay. Mr. Sethi, quick last point then. You're hoping to operate at 40% plus margins, very aggressive inventory addition plan with, close to 400 rooms. Leave us with a guidance on debt as well, because that's been fairly sticky, northwards of 2,000 crores. So what's the plan? Will you be taking on a little more debt, leveraging the balance sheet as you go through the expansion, or would you be able to pare it down as we look at, the starting of the next fiscal?
So Subi, we're a very, very high growth company right now. Just to give you a reference on the debt side, we were at 2,234 crores on 31st March of last year. We are currently at 2,271, which is an increase of only 38 crores in 9 months, whereas we have put in 332 crores of new capex to fund the growth. So large amount of the funding of the growth is happening through our internal accruals. But we are not right now keen on paring down the debt because we want to continue to grow at a very rapid pace. There are a few more products which are coming in way. We've got the Delhi Hotel, which is going to start construction very soon. We've got a Hyatt Regency in Airoli with 260 to 280 odd rooms. That's going to start soon. And we may have one more office at Hawaii that'll come up. So all of these will require capital. We don't see us paring down debt for at least another year. And after that, as these capital works under progress start yielding EBITDA, we'll be able to pay down debt soon after that.
Okay, that point is well taken. I think 740 crore is the capex that you've outlined over the next 2 years. Mr. Sethi, thank you very much for joining in. That is Chalet Hotels for you. By the way, for the market, we've taken a nosedive now. The Nifty is down 260 points. It's 17,850. So that 17,900 mark is gone. On the Sensex, it's a near 900 points fall, 1.5% lower, and there's been a vertical slide in the market, and that's courtesy many of these large cap names. So HDFC Bank, HDFC Limited, ICICI Bank is under pressure, and you can see a vertical fall in many of them in the last 10 minutes. All 12 constituents of the Nifty Bank are now trading in the red, with names like Bank of Baroda down 5%. All the sectoral indices trading in the red. It's the PSU Banking Index which is dragging the market 1,200 points lower. The advanced decline ratio has 2,400 stocks in the red. So this is turning out to be a fairly ugly expiry for us. It'll be a good time to get in a few technical trading ideas, find out what Mitesh Thakkar has made of the fall that we're seeing.